All right, well, the bond market isn't buying all the optimism over the end of the global recession. Despite some improving economic news, investors have pushed yields and government debt to the lowest level since April. Bill O'Donnell, head of Treasury strategy at RBS Securities, says the economic optimism is just a sugar high. He joins us now to explain. So, Bill, as you know, we've seen quite a rally in the equity side of things. A lot of people saying, well, the news, it's getting better on the economic front. Treasury market, though, seems to be telling a different story. What do you think?
Well, I'll tell you, when I go back through the 30 years of history that I have in observing the Treasury market seems to have a propensity to look roughly 6 months forward. And I think what the Treasury market is now pricing itself to is their expectation that around 6 months forward, we're going to be looking at significantly weaker economic data than we're looking at right now. Data that's perhaps somewhat pushed upward by the transitory stimulus programs like cash for clunkers, first-time homebuyer tax credit, and the stimulus itself.
That's what you call the sugar high, I'm assuming, right?
Exactly.
Isn't that sugar high, though, exactly what Keynesian economics is based on to get us out of this kind of slump? I mean, we're supposed to pump the primer, and that gets the engine kicking again, right?
In theory, I suppose that's true. But what we're struggling with here and what the Treasury market is clearly focusing on is the difference between the optics of change as opposed to level. And just because the numbers seem to be getting, in most cases, less negative, or as in the case of the Chicago Purchasing Managers Index today, now slightly positive, I still think the Treasury market is troubled by what lies ahead. And in particular, the market seems to be paying close attention to the miserable state of household finances. Households remain extremely indebted as measured by the debt-to-income ratio, and at the same time that we know household assets on the other side have collapsed as a result of the price declines in homes as well as in stocks.
Hey, David, we want to bring you back into this. I'm assuming you're listening to what Bill's saying.
Yes, I am.
And, you know, in terms of what the Treasury market seems to be forecasting, I think Bill makes a good argument. I mean, where do you lie in terms of this?
I think he's right that this tax stimulus is going to be more of a short-term positive effect. But when you weigh in the monetary stimulus, which may be the greatest we've seen in 50 years, that's where I get, frankly, more positive on asset valuations, both for stocks as well as in his market, in the corporate bond market, not treasuries. I don't get excited about 3.4% yields for a 10-year U.S. Treasury, but I sure do get more excited about the opportunity to buy 6.5% or better yields in a BBB investment-grade bond, even better in the right element of high yield. That's where I think asset values can still move higher.
Bill, don't you think, I mean, if we can see the needle moved on GDP with just a $2 billion cash for clunkers program, and we're going to spend a lot more money on stimulus next year, doesn't that move the needle even further? I mean, we're only spending $100 billion of the full stimulus bill this year, and another $300 billion is going to be coming out in 2010. Isn't that enough to move the economy?
I'm sure it can in the short term, but again, what resonates with us is the observation that American consumers have spent the last 25 or so years increasing their personal consumption expenditures. We tend to measure it against GDP, going from roughly 62 to 64% of GDP up to present levels at around 70% of GDP. That looks unsustainably high. Meanwhile, households have spent the last 20 to 25 years strapping on significant and ever-increasing amounts of debt. And the difficulty of the last 12 to 18 months is that we've seen a rather dramatic drop-off in asset prices, and at the same time, consumers are left with a sort of 25-year legacy of debt. And we just don't believe that you can unwind 25 years of profligacy on the expenditure as well as on the debt side in 1 year.
Right.
And it's going to take more than government stimulus, transitory as it is. What it's going to be is going to take time, income growth, which grows historically at around 3%. It's going to be a long time to fill that gap.
All right, gentlemen, we have to leave it on that note. Bill O'Donnell, thank you so much. And also David Sowerby, we appreciate your time this afternoon.
Thanks, Carol.